Good morning, everybody. We will be making a start in the next 1 to 2 minutes, so just as we let a few more people into the forum. So appreciate you joining us, and we'll start the presentation momentarily. Again, for those who have just joined, we're just waiting for a handful more people to be let into the forum, and we'll start within the next 1 minute. Appreciate your patience. Okay, I think we've got a quorum, and conscious of people's time, we will make a start. And just reminding that there will be a recording made available of the presentation, made available to all attendees, and available on the various social media platforms. Okay, so hello and welcome to everyone. My name is Greg Taylor. I'm the Portfolio Manager of Solder Brothers Emerging Companies Limited, SB2, which is an ASX listed small cap listed investment company. If I might just jump over to the opening page. What we've got today is our monthly webinar series where we have a review of portfolio and performance, look at some key drivers and key topical matters in relation to the market in which we invest. You've got your standard disclaimer there, which again, the copy of this presentation has been made available on the ASX. And but what I was looking forward to discussing today was just revisiting Australian small cap versus large cap valuations, and especially in the context of a change in interest rate environment where there's increased likelihood of a reduction in interest rates, and probably a little bit more meaningful and earlier than many people anticipated. So what that may mean for the market. Then I'll jump into, again, recent performance, both on an absolute sense. Then we look at just how the fund and the assets have performed relative to broader benchmarks globally. And then, as we often do, finish up with just a review of the portfolio positioning and the key metrics. But just to jump over the slide again, and a little bit of a recap or executive summary of the group. Firstly, for those not familiar, Solder Brothers is a global alternate asset manager with over $4 billion of assets under management, spread across the asset classes of property, credit, and equities. We have 5 equity funds. The one we're talking about today, as I touched on, is Solder Brothers Emerging Companies Limited, SB2, which is a managed listed investment company. Important to highlight that it's dedicated to investing in small cap Australian companies with a market capitalisation of under $500 million. So very much a small/micro cap fund in the space. Pleasingly, the fund has a long track record, coming on 4 years now, but since inception, and it's definitely over the last 3 years, we've got a consistent and strong track record of outperforming the small cap market. we don't manage the fund relative to a benchmark, but we provide the absolute and relative performance in this presentation. But most notably and more recently, the 12 months through to April, the fund has returned a positive 16.3% performance, and that's materially outperforming the broader small cap market, to the extent of over 15%. Another dynamic of the fund is it does trade at a discount to the underlying net tangible asset value of the assets, and at the moment that discount is at 32.46%, which basically means you're getting the portfolio of assets we'll talk about today. You're able to invest in those at a 30% plus discount to their underlying asset value on a post-tax basis. So very much an attractive risk versus reward proposition. But jumping over the slide, I'll just I've touched on this probably just on 12 months ago, just the relative performance and valuations of the small caps versus the larger caps in the Australian market. And for large caps, we're looking at the ASX 100, and then we're looking at the Small Ords as a proxy for small cap Australian equities. And what you have here is the relative valuations of the two, and what you can see over a deep data set over 20 years, rarely does that valuation differential get above a 12% or 13% premium in favour of large caps over small caps. And we're at that extreme point again. So despite us calling this out 12 months ago where we saw that gap close, what you've started to see is it getting wider again. So the underlying, it's important not just the valuation relativities of the things, but the underlying fundamentals of the small cap universe versus the large caps. And what's interesting is the consensus forecast earnings growth rate is very much in favour of small caps, which is often the case versus large caps, and also the strength and quality of balance sheet is also very solid with respect to small caps. So you've got good earnings growth, strong financial balance sheets, and a material valuation differential. And what this chart tells you is that over time it can go from one extreme to another, and with the exception of the financial crisis in 2008, which was only a short-lived phenomenon, you'll see that they don't stay at these extreme levels for long. So I think we're in a period of relative attractiveness for small cap equities, and I think hopefully that means the next 12 to 18 months should see positive performance for small caps. If we jump over the slide again, a really important determinant for sentiment and performance of small caps is interest rates. And again, we did some work about 12 months ago in a research paper which we released, that the single most prominent driver of small cap returns was the level and direction of interest rates, and with obviously a negative correlation. So as interest rates go down and are lower for longer, better the performance of small caps. And what we're seeing now is increasingly the broader global markets betting on earlier and increased rate cuts, which will see that downward trajectory probably come quicker than and more prominent than most people were anticipating only 6 months ago. And we're just starting that process. You've seen some interest rates globally being cut, and obviously coming into the Australian market, that dynamic in play as well. So really could be an important catalyst for small cap performance and small cap sentiment. And we touch on here just a few of the drivers behind this negative correlation, but ultimately big driver is consumer sentiment, business sentiment, investor sentiment ultimately is the key determinant. So in summary, we think it's still very much a good time to be investing in small caps. The relative valuations is as attractive as it's been for coming on 15, 20 years, and the underlying drivers are in our favour. So definitely building a strong case to have exposure to small caps in the next 12 to 18 months. So if I jump over the slide again, we touch on performance, and so for the 3 months, I think everyone who follows the markets will acknowledge how volatile it's been this calendar year, and some pretty extreme situations unfolding as recently as in the month of April, where we had global markets off 10% overnight, which is almost unprecedented. We actually put out a research paper all around the issue of tariffs, the likely impact on the Australian economy, Australian investment markets, and specifically the SB2 portfolio, and concluded that we didn't think it was something that's going to persist for a long time, and it created somewhat of an opportunity. It seems that research piece is dated already, because we're back at the scenario where most of those declines in early April have now been fully recouped, and even for the calendar year, most markets are now in the positive. So pretty remarkable times. But we're continuing to sort of hold track with the benchmark over this shorter time. But if you look over the longer time periods of the 12 months or inception, which is, as I said, coming on 4 years now, there's been consistent outperformance by the fund, which is very, very pleasing, and I'm really confident on how the portfolio is positioned going forward, and about the ability to maintain that. The next chart, we thought we'd kind of bring that all into context a little bit, and it looks quite a busy slide at first, but once I talk through it, it's relatively straightforward. But what it's showing is the underlying portfolio performance of SB2's NTA, so that's the portfolio performance of the asset value, since December 23 through to now. And as you can see, whether it's relative to domestic small caps, domestic large caps, or global small and large caps, it's outperformed all of them. And this is in a situation where, again, probably the sentiment and liquidity hasn't been in our favour. So it's really pleasing outcome for the team and Solder Brothers as a group, and gives us some confidence that our philosophy and process works through multiple cycles. And the exciting thing is now that the outlook actually looks quite positive for our sector, and really excited about the portfolio we've been able to pull together to continue that performance and track record. So as we jump over the slide here, it's a bit of a snapshot of the portfolio that we provide, including the top 5 holdings and the overarching metrics of the portfolio. And I guess what I can say is, I've been presenting this for over 12 months now, and I've spoken about these attractive metrics and the weighted average upside of the portfolio. And as we've touched on, the 12-month performance has been sort of in that 15 to 20% positive range. Despite that, the underlying metrics are as attractive as they have been throughout the last 5 years. And I always talk about this context of I've been fortunate enough to be managing Australian small caps for over 20 years, and I've been valuing that basket of stocks with a consistent approach over that period. And again, we're still in this period of time where the weighted average upside of this sector is as big as it's been in 25 years, and that's from the bottom up. That's from our own work and own screening and valuation work on the market. And I speak to, in 2008, there was a time when the weighted average upside was greater than 70%. That was the global financial crisis. 2016, ironically, about 8 years later, you had the credit crisis, and we had sort of circa 75% upside in the sector. and now we're at those times again. In each of the two previous times, the following 2 years delivered greater than 100% returns for the sector. There's no guarantee that that's going to happen again, but I think what it shows you is that history typically is a great guide. So I'm really confident about the bottom up. We've spoken about the top down dynamics around relative valuations versus large caps, the positive catalyst of interest rates, but then looking at the portfolio and upwards, it's really unprecedented times in risk versus reward. So I speak about this, investing so long in the sector. I often get excited about finding a single company that's growing at 20%, is profitable, and I can buy on a single digit earnings multiple. We're in these unique times where I've got a portfolio of greater than 20 holdings that exhibit those weighted average metrics, which again really gives me confidence around the outlook. On a few of the stocks there, again, you've got the top 5. Hasn't been a lot of change over that recently, but in saying that, there's a couple of new positions we've entered, and typically how we work is that we build our way into positions. So again, circa $100 million fund, on average sort of 20 to 25 holdings. So average position size sort of $4 to $5 million, and we might start with a $2 million position. After a detailed due diligence, we'd start with that, then we track the company further, and then might build into a larger position over time, with genuinely taking a 2 to 3 year view. So you shouldn't expect to see significant turnover in the top 5 holdings from month to month, but from year to year, we'd like to think that positive relative performance sees us taking some profits and getting conviction in new opportunities that drive up. And so companies there, which again I think looking at the attendees, most of you are familiar with, and what I can say with great confidence is, over the last 3 months, the portfolio's sort of, in my mind, sort of tracked sideways a little bit in line with the market, and there's been other factors external to these companies, and even specifically the Australian small cap market, that's driven share price. So we haven't had a lot of luck out of these, but the underlying fundamentals of these businesses are as strong as ever. And just to call out one of the reasons we increased our position around the Better Entertainment, the BBT investment, was the opportunity for them to acquire the PointsBet business, and that's been a bit of a process, and only this week they got the news that PointsBet have finally allowed them in for some high-level due diligence, and I think that's tracking towards a likely transaction. If that goes through, there's 100% EPS accretion in that transaction, and again, that's pretty rare that you see that in any transaction. So we're excited about the upside there. I've spoken about AI Media at length, but and the great thing on this company is that I had the opportunity earlier this year to go over and meet the key customers of AI Media and understand how they're thinking about the next couple of years with the use of the AI Media product suite and technology. And I continue dialogue with those companies over time. And AI Media's big product release was a thing called Lexi Voice, which was basically a voice translation technology using AI that's been used by some of the biggest companies in the world, including Microsoft, LinkedIn, Disney, ESPN, just to name a few. And they launched that at a recent global trade show only a couple of months ago. And the feedback I'm getting from the market, being the industry, is the response was extraordinarily positive. AI Media even talked publicly about it's the best response they've ever had. But more importantly, I understand there's quite a lot of opportunities where there's these big global media companies trialing that new technology, and if they were to take that on, it would materially transform the earnings profile of AI Media. So very confident about that. I did note a question came in around Alfab, so I'll wait until we get to Q&A before I address that one. But again, that's tracking very well. So that's all from intended on covering today before we get to Q&A. I did just want to just recoup that, we're very aware, we focus absolutely on the underlying performance of the portfolio, but also put a lot of energy and effort into closing the discount to NTA. We've had some success with that, slipped back a little bit with the negative sentiment and volatility in the market, but we still do have a live share buyback in place. Last month we announced and paid a fully franked dividend for the first time. Confident about the ability to increase and maintain that over time. At the moment, it's on an annualised fully franked yield of about 6%, the SB2 fund, so you're getting a nice tax-effective dividend there as well. And initiatives such as this, and only earlier this week I presented, last week I was around in interstate seeing a number of wealth management groups raising the profile of SB2. I presented at the Morgan's National morning meeting earlier this week, and continuing a lot of marketing initiatives to help drive awareness and demand for the shares as well, to close that discount. So continual process, confident we're heading in the right direction with that, and confident about the medium-term outlook for the fund and the sector. But I'll pause there and jump into any Q&A. So Megan, I noted there was a question that came through. Was it in relation to Alfab's, AAL?
Yeah, that's the one.
Yeah. I actually can't. So let me open the chat and see if I can see it there. Yeah.
Do you want me to read it out?
I know, I found it now.
Okay, great.
Look, the question I think everyone can see it there is, do we consider the weakness in Alfab's share price, which is down 10% today, to be related to the FWC's decision on same job, same pay as covered in the AFR? It always in short, potentially, but does that fundamentally change the investment thesis for Alfab's and AAL? And should the share price be down on this news, let alone 10%? Absolutely not. And so, the dynamic you do get with investing in small and micro caps is small volume moves or small liquidity moves drive big share price movements. And so from day to day or month to month, you get these wild swings in volatility. Like using today as an example, Alfab's less than $100,000 worth of stock is transacted. Again, this is north of $100 million market cap company, and it's has someone woken up and connected those dots and think that might not be good for AAL, potentially, but it also only takes one other person to look at the fundamental positive drivers behind this company that will far outweigh any potential impact from today's article. And if we go back to the investment thesis for AAL or Alfab's, is that it's got significant contracted revenue that underpins north of 30% earnings growth for the next couple of years. It's got a really unique position in its engineered construction business, which focuses on that civil construction space. It's got some problems up in the Hunter, where it services the coal industry with asset hire and maintenance services. One of their key competitors in market is experiencing significant challenges. I'd define those challenges as sort of internal challenges, not sector challenges. So this business has so many positive tailwinds behind it at the moment. It's trading on a below 5 times earnings multiple. It's got a fully franked yield of again, high single digits and with 30% plus growth. So my view is, I apologise, I'm in a room where the lights have gone out on me, so I'll just have to get those on again. So our Fabs, the investment case, I've caught up with management only in the last month. Very strong momentum in that business, really confident about their short-term earnings profile and their medium-term earnings profile, significantly undervalued and not well held. And, it would take a very small trade in the market, and this would be trading back at the share price it was yesterday. So I personally wouldn't be too concerned about, though I share the frustration when you hold any company that gaps down 10% on less than $100,000 of volume, but unfortunately that's the market in which we invest. So hopefully that helps. But all right, are there any other questions? That's all I can see in the chat at the moment.
No, that's it.
And again, as always, help. We make ourselves available. I think on the final slide you'll have some contact details there, where you feel free to reach out and contact us with any questions or comments. And again, a recording of this presentation will be made available to you all shortly as well. So again, I appreciate your time and interest, and look forward to the next update or any communication opportunities we have. Thank you again, and goodbye.